We are now going to talk about participating and non-participating life insurance. And this topic still applies to whole life insurance. And so when we talk about par and non-par, certain whole life plans, participating whole life plans, in fact, make the policy owner eligible for dividends. Dividends are, as you may or may not know, dividends are coming out of profits of insurance companies. Companies that have a profit can declare a dividend. And certain whole life policies participate in dividends. And so when we have a whole life policy referred to as a participating whole life policy, this means that it participates in dividends from the insurance company. A non-participating whole life policy does not participate in any dividends. And so if you think about an insurance company and the fact that they have to invest money that you are giving to them each year, they're making long-term commitments because your premiums are the same for the next 20, 30, 40 years, and so they have to invest that money for that time. They tend to be fairly conservative in their long-term investments. However, if they are good in those investing, then they can make additional profit. And so if I'm running an insurance company, where can I make money? How do I make money? Well, very simply, I have to make certain assumptions over the long term about the number of people that unfortunately are going to die. Because when they die, I need to pay out their death benefit. And so if in fact fewer people die than I expected, than I put in my pricing for my policy, then I've got a source of some additional profit. In addition to that, my investment department, if they've had a good year and they in fact have invested properly and had higher returns than we would have expected or that we planned for, that's another source of profit. That's good for us. In addition to that, if our expenses in running the business are lower than we budgeted for, that's another source of profit. So insurance companies make money where fewer people die than expected. You get higher investment returns from their investment department, and they're operating in an efficient business. So now, when we are owning a participating whole life policy, those additional profits that the insurance company have earned, they in fact are going to be shared with the participating policyholders. And so if I own a non-participating policy, any of that additional profit or surplus that the company makes, they keep it. And so if the company is shortfall, in other words, they don't make their profit targets, then it's up to the company to reconcile itself with that. So profit or no profit has no impact on non-participating policies. However, participating policies, if in fact there is a surplus, in fact they've made a profit, they in fact will share part of that profit with a participating policyholder. And that's what a dividend is. A participating policyholder can receive a dividend as a result of being a participating policyholder. Now, they'll pay a bit more premium than the non-equivalent non-participating policy, but that little additional premium is what the company takes and invests in its business. And if it's profitable, they will share that through a dividend. No different than a publicly traded company. When you buy shares in one of the Canadian banks or large insurance companies, if they have a profit, they're going to share the dividend with you as a shareholder of that company. Very similar to a participating policy. If you are a participating policyholder and your insurance company makes a profit, they will share part of that profit with you. Now, recognize that dividends, whether from insurance companies, banks, or anywhere else, are never guaranteed. And so when someone buys a participating policy, they're going on the assumption that this insurance company has a history of paying dividends and will continue to do that in the future. So let's talk about dividend options. As I said, a participating policy, I receive a dividend. So I've been paying my premiums each year, and at the end of the year, the company declares a dividend on my policy. Now I can do lots of things. There are 5 different things I can do with that dividend. First of all, I can receive it in cash. I can say, please send me a check by mail for my dividend this year. And so receiving cash is one option for my dividend. A second option is, you know what, don't send me my bill for $1,200, for example, for my annual premium. If I have a dividend of $50, just send me a bill for $1,150 next year. And so use my dividend to reduce next year's premium. The third option is, you know what, I don't need that dividend right now. Can you put it in another policy? Can you put it in another savings account with your company? I want to accumulate additional money in a separate plan. So I can put that in a side fund to accumulate it. So I can receive it in cash, I can say reduce my next premium, or I can say put it aside, start another investment for me, and every year I get a dividend. Let's build up that side account. The fourth dividend option is something called paid up additional insurance. Now, paid up additional insurance very simply says, use the dividend. I don't need it. I don't need the cash. Use the dividend to buy me some more insurance. In fact, use the dividend to buy me some more of the same kind of insurance that I have. And so that dividend will be used as a single premium to buy a sliver of insurance. So what happens is my death benefit, in fact, increases. Every year I say, oh, use the dividend to buy me a bit more of insurance. It means every year my death benefit on my policy is going to increase each year. And that additional coverage means, and some people use that as an inflation hedge. In addition, that additional bit of insurance, in fact, I don't have to provide any additional medical evidence for that coverage. And so if I keep my participating whole life policy for a long time, and I use the dividends to buy additional insurance, then I have coverage that is building up each year. The fifth dividend option is also providing me with insurance, but it's not the same insurance as the base plan, which is the example, the previous example, buying paid up additional insurance. The fifth dividend option allows me to buy term insurance, 1-year term insurance. So I can use that dividend, I use it as a single premium to buy additional coverage for 1 year. At the end of that year, my additional coverage is gone. I may have another dividend at the end of that year, and I say, okay, buy me another 1-year coverage. And so the difference between paid up additions and 1-year term is that 1-year term will in fact give me more temporary coverage for 1 year than paid up additional insurance. Paid up additional insurance gives me the same as the base plan. Term insurance, 1-year term, simply buys 1-year term for that term. So again, we need to remember, with respect to participating whole life policies, we have 5 dividend options, and they are cash, send me a check, reduce my next premium, cash accumulation, in fact, accumulate my money in a side fund, buy me additional insurance of the same type I have, or buy me additional term insurance. And you can change your option every year. If you decide, oh, I want to have cash this year, but next year I want to, in fact, buy paid up additions, you can do that by notifying the insurance company every year.